How does ACV work in an insurance claim? Have you ever wondered how insurance companies determine what they will pay you when your car is damaged or stolen? Let's break down the concept of actual cash value, or ACV, and how it plays a role in insurance claims. Actual cash value is the amount your insurance company will pay you for your vehicle after a loss. This amount reflects the vehicle's current market value at the time of the incident. Unlike the original purchase price, ACV takes depreciation into account. This means that the older your vehicle is, the less it may be worth when you file a claim. When you file a claim under collision or comprehensive coverage, the insurance company will first assess the replacement cost of a similar vehicle in the current market. Then, they subtract depreciation to arrive at the actual cash value. Depreciation considers factors such as the vehicle's age, mileage, wear and tear, condition, accident history, and market demand. For example, let's say you bought your car for $25,000. If a similar new car now costs $27,000, but due to depreciation, your vehicle has lost $10,000 in value, the actual cash value would be $17,000. This is the amount the insurance company would pay you, minus any deductible you owe. Understanding ACV is important because it directly affects how much money you receive after a total loss. Since ACV reflects depreciation, it may not fully cover the cost of replacing your vehicle with a new one or paying off a loan or lease. This is why some drivers choose to add extra coverage, like new car replacement insurance or gap insurance, to protect against this potential shortfall. In contrast, replacement cost insurance would cover the cost to replace your vehicle with a new one of the same make and model, without factoring in depreciation. This can be a more appealing option for those who want to ensure they can get a brand new vehicle if theirs is totaled. In summary, actual cash value is how insurance companies determine the value of your car at the time of loss. It balances the replacement cost against depreciation, ensuring the payout reflects the vehicle's fair market value rather than its original price or replacement cost. Understanding this concept can help you make informed decisions about your auto insurance coverage.